and I appreciate everybody coming in this evening and giving me their time. Just a little background about myself. I'm a graduate of the University of Pennsylvania. Hey, good evening. And I'm a former professor at Jefferson University in Philadelphia. And I've been involved in the financial markets for over 20 years. And I began trading the futures and Forex markets about 10 years ago. And the area of my thesis was the optimization of multivariable equations. At the time, what I did was I optimized a multivariable equation that consisted of underwater decompression schedules for the U.S. Navy. And then ultimately, I brought that same type of system to bear on the futures, Forex, and stock market. Because basically, if we look at the movement of the stock market and try to determine its direction, what it consists of is really a group of multi variables in an equation, which ultimately gives us a dependent variable, which is the outcome. And now our goal is to define all the independent variables, optimize them one by one, and thereby optimizing the sensitivity, specificity, and positive predictive value of our trading entry. And really, that's what we do here at Right Line Trading, and our email address is www.rightlinetrading.com. Yeah, I'm just going to pass a whole bunch of slides here. Now, I really want to get to rotational markets and how the big institutional guys move money from different asset classes. But I just want to give you a little bit of background about our platform, because I want to spend a lot of time displaying it, and to the traders out there who have never seen it before, it's going to be a little bit confusing unless I give you a little bit of background. Now, there are two basic underlying strategies that software developers take when they're looking to develop a program to define market direction. Now, there are those that simply believe that price action is going to be enough to provide a trading entry is going to be enough to provide a buy or sell recommendation with the predictive value high enough to make you profitable. And then there's the group of software developers that believe that some confluence of indicator signals at some unique composition is enough that when they all align, will again provide you with a buy or sell trigger, a blue dot buy, a red dot sell, and those blue dot and red dot buy sell signals are going to have a sufficiently high predictive value to make you a profitable trader. And there's a further subdivision of both the price action and indicator analysis people who believe that you have to trade multi-time frames in order to confirm the validity of your trading entry. At Right Line, we believe we really reject and accept all of these hypotheses. We believe that price action alone does not provide you with a high enough predictive value on your entry to get you where you want to be, to get you to profitability. And there's no confluence of indicator signals without respect to price action and market structure that are ever going to make you profitable. I mean, that's the search for the Holy Grail, and I think one of the mistakes that a lot of day traders and swing traders make. And that is, if they have a bad day or they're not doing well, they look for that one additional indicator that they believe that's going to bring them to profitability. And I want everyone to remember that there are only 4 parameters that are projected on any trading chart. They are the high of a candle, or configuration. It can be a candle, it can be a high-low close, but there's only the high price, the low price, the open, the close, and volume. Those 5 parameters are the only parameters that are projected onto a chart, no matter how it's configured. And it's simply a matter of using different formulas to provide different signals to crunch those same 5 parameters. So there's just so much you can do with them. And after a while, what you're doing is you're crunching numbers in a redundant way, and you're simply looking at the same data being projected on your chart in an overlapping fashion. And as I said, if either above were true, it would be really easy to robot trade the market for millions in profits if simply some confluence of indicator signals could get you exactly where you want to go. So it's the goal of right line trading is to combine all of them. We have a tremendous respect for market structure / price action. We look for indicator analysis to confirm our entries, and we believe that fractal analysis is really important. Now, fractal analysis is looking at multi-time frame analysis. Now, that's very, very difficult to do if you're trading any given market. It's even tougher if you want to project multiple markets at the same time. So if you're trading, for instance, in the morning in the live trading room, we trade gold, crude, the Russell, and the E-mini S&P. Now, if we were to look at multi-time frame, multiple charts on multiple time frames for all 4 of those markets, we would need an enormous number of monitors, and impossible for us to see all the information. So what we do is we've created fractal indicators. And the fractal indicators analyze data from multiple time frames and synthesize that down and project that onto your trading chart. And at right line trading, we have a very, very specific methodology, which we adhere to very, very dogmatically. We don't call tops or bottoms. We don't trade reversals. We don't counter trend trade. We don't try and predict breakouts. We are trend traders only. Now, the people that try to call tops and bottoms, I'm going to show you when we get to our charts, get consistently run over. People that counter trend trade, it's my belief that the trend is established by the big institutional guys. We do not want to try to buck the trend when the institutional players and the big money are setting up a nice trend. So we don't ever counter trend trade. We don't, again, call tops or bottoms, and we don't try to predict breakouts. And there's no software if a market goes 3 candles is going to predict for you with a high enough predictive value that it's going to go a 5th, or it's going to go a 6th, or it's going to go a 7th. Some of the anticipatory breakout systems are pretty decent, but they're going to give you a lot of false signals, and you're going to get stopped out a lot. And just remember one thing, that if you trade with sensitivity, then what you're going to try to do is to get into as many true positives as you can, so that every small movement in the market, whether it's a candle or 2, you're going to try to get in and try to get some money out of that trade. If you trade with a lot of specificity, you're going to wait for everything that you're looking for. All the parameters that you use to define a market move, all the parameters that you use to define a successful market move have to align. And the only way to make money as a day trader or as a swing trader is to trade with tremendous specificity. It is more important to define the true positives and to weed out the false positives. In other words, you're not so much looking for the true positives, you're looking for the false positives. You do not want to trade a bad signal. And the only way to do that is to trade with a tremendous amount of specificity. Now, here's simply a chart of price action. And you can see there's market structure, there's price action, and there's information provided to us on this chart. You can see, I hope if you can see the cursor here. Can they see the cursor? You can see that this is an engulfing candle right at a low pivot. And this engulfing candle, hey, thank you, Doug. This engulfing candle at a pivot really, it tells you that there's a tremendous amount of buying activity here. This is an 8 range. It's an 8 range candle body. This with a significant amount has a significant amount of validity and precision, and you can see that it calls a reversal. Here's a swing pivot high, and you can see that this engulfing candle calls a reversal to the downside. And if you have a wide enough stop, you can ride this all the way to the bottom. The problem with trading price action alone is I don't think that you can trade with enough sensitivity and enough specificity to filter out all the bad signals and the bad moves and to filter out the static. That's why we add indicators. So really, we have a lot of respect for price action and market structure, but we believe that without indicator analysis to further define this parameter, we can't trade successfully. And so what we do is we simply add a 50-period simple moving average. Nothing complicated. You can get this right off of the Ninja platform. The only thing we did is when it's green, when it's moving up, when it's red, it's moving down. And this simply it not only defines support and resistance, it also defines momentum. When it's moving to the upside, momentum is to the upside. When it's moving to the downside, momentum is to the downside. Now, since we put this up, we've also created a yellow color where it's only plus or minus 1 degree to give you an idea when the 50 is pretty flat. And what we believe is that when you're above the 50, the bulls are in control. We never go short above the 50. We only go long. When we're below the 50, we believe the bears are in control. We never go long below the 50. We only go short. Now, this is leading to the specificity of our trading. We've now defined something that eliminates a large number of potential trades, and that is we can't go short above and we can't go long below the 50. In addition, we've created a 15-period proprietary moving average. If you put the 15-period proprietary, we call it the right line trend, and superimpose a 15 exponential and a 15-period simple, you'll see that they crisscross back and forth. And what we've done is, since we want to trade with specificity, we want to create a line that's extremely stable. We want a line that's going to let a lot of price action go by without being able to turn it from yellow to green or blue. And when we have a yellow modified 15, we define that as chop and we don't trade. Now, sometimes the market will make a significant move off of a yellow 15, but we don't care about that. Because if we're going to trade with specificity, we're going to have to let some successful moves, and sometimes some big moves, go in order to catch the successful moves and weed out all of the unsuccessful ones. So we want to go short when price is below the 50 and below the 15, and the 50 and the 15 are red. We want to go long when price is above the 50 and above the 15, and the 50 and the 15 are green. So now we're adding to the specificity of our trading. We're adding rules that we never break. We never trade a yellow 15, and we almost always wait for the 50 and the 15 to cross the 50, the 15 to cross the 50 to the upside. We want green, green. We want red, red. Sell below, buy above. And now we added pivots. Now, there are times when I'll trade into an unbroken pivot, but I do so with a lot of trepidation, because what we did was we did a year. The whole platform has been mathematically optimized. Every parameter and every single indicator that we've put on the platform, we have shown via a year of market replay data to increase our equity curve. They increase specificity, and they provide us with additional precision. There's nothing on here. And we've had a lot of stuff rotate in and out. If it doesn't help us to get a successful trade, we boot it out of the platform. And what we did was we looked at whether or not trading into an unbroken pivot was going to be helpful, or whether it was going to hinder our trading. Now, there's a lot of moves that just walk through an unbroken pivot like it's not there. And sometimes it's embarrassing. It just doesn't blink. You stand aside and bam, off it goes. But for the most part, we don't trade into unbroken pivots. On a move down, this is where a lot of buyers are waiting to turn the market up. On a move up, this is where the market's proved to have a lot of sellers waiting to turn the market down. Now, the only thing that you can use to try to mitigate that rule, which is not as hard and fast as the 50 and the 15 is the more times that a pivot is hit, the more likely it's going to break. And the smaller the pivot is, the more likely it's going to break. So my pivot sensitivity is set very low to try to give me only major swing pivots. But if it's a tiny pivot that's traced out, maybe I will trade into it. If it's a pivot that's been hit 3 or 4 times, maybe I'll trade into it. Remember, 10 to 15% of trading is discretionary. And there may be a trade that you don't take, that one of your colleagues will take. It's all based on risk management. If your risk tolerance is a little bit higher, you may decide it's okay to trade into this unbroken pivot because it's been hit twice. If the person sitting next to you is even more conservative, he won't trade into an unbroken pivot under any circumstances. Now, what we've also defined is that the difference between the candle open and support, in this case, this is the modified 15, and we have an indicator. When it becomes more than 4 ticks on an 8-range chart, the positive predictive value of the entry begins to fall. In other words, what you want to do is trade as tight to support for a move to the upside and as tight to resistance on a move to the downside as possible. And what we did when we looked at a year of market replay data is see that as the distance from the candle open from the modified 15 or the 50 begins to get larger and larger, the more likely it is that instead of the trade going your way, it retraces right back to support or right up to resistance, stops you out, and then gives you a successful trade. So we created an indicator that dynamically tells you how many ticks you are, how many ticks the candle body open is off our modified 15. We like to stay 4 or less. Occasionally, we'll give it a little bit more on a perfect trade, remembering that if we take a trade like that, we are taking on a little bit of an additional associated risk. When we trade 1 or 2 ticks off the 15 or right off the 15, those are awesome trades when they come right off support and right off resistance. Now, we've also determined that order flow and momentum are 2 indicator parameters that are very, very important. Now, order flow, now this is our 3-line indicator. And believe it or not, since I made these slides, the 3-line indicator is not projected on the chart anymore, and you'll see how we did it. We actually tried to simplify the chart, and we did so. But the 3-line indicator, line 1 is order flow, line 2 is stochastic, and line 3 is momentum. Now, as I mentioned, we do not want to use order flow, stochastic, or momentum based on 1 time frame. Because if we do, order flow on your 2 higher time frames or 3 higher time frames may be in the opposite direction. We want to get order flow to align on multiple time frames. We want to get momentum to align on multiple time frames. So if line 1, 2, or 3 is red, it means that order flow is aligned to the downside on multiple time frames. If line 2 is red, stochastic is aligned to the downside on multiple time frames. And if it's red on line 3, momentum is aligned to the downside on multiple time frames. Green, just the opposite, aligned to the upside on multiple time frames. Now, we believe that long-term time frames rule, so when it's orange, your longer-term time frames are down, shorter up. What we really like to do is have these aligned. We like them all red, or we like them all green. Now, what we did is we don't take anything for granted that people tell us. Everybody tells us how important stochastic is, not to buy an overbought or oversold market, and to use stochastic as a parameter to define an oversold or overbought market. So what we did is we simply took, and stochastic is just one of many oscillators. And we took the stochastic, which was a fast stochastic, and we did a year of market replay data, and we looked at the positive predictive value of our entries when stochastic was with us and when stochastic was against us. And what we found was that the stochastic indicator, although everybody takes it as being valid, gave us no additional predictive value. It didn't increase the validity or precision of the trades at all. And it really does make sense, because if you look at how people and I know I'm talking fast because I really want to get past this and get to the meat of this, which is money flow and rotational markets. But if you look at how people view stochastic, a lot of people, or half the traders, when stochastic is overbought, believe that the bulls are in control of the market. And what they do is they continue to buy every time the market breaks a pivot to the upside. Broken pivot to the upside, buy. Open pivot to the upside, broken, they buy. The stochastic indicator is used as a measure of bull-bear power. When stochastic is oversold, they do the same thing to the downside. And then you have the other school of thought that say when the market is overbought based on stochastic direction, they look for a stochastic divergence and look to go in the opposite direction. Now, we all know how valid trading stochastic divergence is. Sometimes it works, and a lot of times it doesn't work. And you take it as dogma and trade stochastic divergence, ultimately you're going to wind up getting wiped out. And what we found is that the stochastic indicator doesn't provide us with any useful information. So line 2 has been eliminated from our 3 line. We only use order flow because we know it's a supply-demand parameter. When there's an excess of buys, an excess of executed buys over an excess of executed sells, we know more people want the instrument than are able to supply it, so they're going to bid the price up. When more people are trying to unload it than trying to buy it, they're going to bid the price down, and the price is going to fall. So order flow is a really essential component to trading, and momentum is really just really a MACD. And I think a MACD as a single indicator is a tremendous indicator, because it's a second order equation indicator. It looks for acceleration, deceleration, and what we look for is momentum on multiple time frames aligned. Now, we've eliminated completely the 3 line, but just to show you quickly how we trade. Here the 15 is up, here the 50 is up. And what we do is we project all the information from the 3 line onto the candles. See how this candle's outlined in blue? It tells you that order flow, now we've eliminated stochastic, so I'm not even going to mention it. But order flow and momentum are aligned to the upside on multiple time frames, and up the market goes. Here's the same. I just made the candle body thicker. We know we have a trend. The 50 and the 15 are up. We know that order flow and we know that momentum are aligned to the upside. And you're going to see this rim around the candle, intra-candle. So you can set your buy stop limit or buy stop order 1 tick above the close of the candle way before the candle closes. You're in when the candle matures, closes, and up you go. Same thing to the downside. It's outlined in yellow. Order flow and momentum to the downside. 50 and 15 are down, and down it goes. We're using market structure, and we're confirming our entry with our indicators. Same thing again. Here the 50 and the 15 are down. We break the 15. The candle's outlined in yellow. It means order flow and momentum are with us. Down we go. We have strict adherence to market structure, and we use the indicators to confirm or increase the predictive value of our entry. Same thing to the upside. Now we actually have it here on a break, but what we want to do is we want to wait for the 50 to roll and we want to take the trade with the 50 and the 15 green, I use this kind of for instruction, but this is a very aggressive trade, because remember, the distance we want between the 15 and the candle body open should be very small. This would not be a trade that we would take. But it's just to show you that what we want to get is the 50 green, the 15 green, and we want order flow and momentum to align. Now, just quickly, this is one of our strongest entries, our C candle entry. And in this particular case, what we do is we capitalize on all the unfortunate traders who are trying to call a bottom and to try to counter trend trade. And from all the people in our trading room, now I just want you to know, in our trading room so far this week, we've taken 12 trades. We have 11 winners and we have 1 loser. You know, I'm always cautioned against giving out a dollar figure, but we're up a lot of money in the room. And we only have 1 4-tick loss, and we have 11 winners. And the reason we do is because we strictly adhere to our trading rules. And we wait for everything to align. And what we really like to do is capitalize on those traders who don't understand how counterproductive it is to counter trend trade. Now, we're not going to beat the institutional guys. If we're going to go home at the end of the day, we're going to go home, unfortunately, with the other commercial traders like us. We're the little guys. I mean, we trade a 3-lot, a 4-lot, a 5-lot. Well, you know what? That's the money that we're going to take home. We're going to take home their money. So what happens? The market begins to fall. The 15 crosses the 50. And you can see the candles. And you can see that they're coming down, and they're outlined in yellow. So order flow and momentum are moving to the downside. And then for God knows what reason, and this happens, it's going to happen for an infinite period of time, and it happens every day multiple times, people decide, you know what, the market's fallen enough, I'm calling a bottom. And this is an up candle. And I just simply decided that my up candle's in a downtrend and my down candle's in an uptrend, I'm going to color magenta. Now, when the B candle forms, you get an audible alert. And then what you look for, now the A, the B, and the C, I didn't put on the chart. They're put on by the software. Any 2 candles in a row of the same color define a trend, and A starts to flash. 2 candles in a row, it prints. As soon as you get the up candle in a down move, as the candle is forming, the B flashes. When the uptrend candle closes, the B prints, you get an audible alert. That tells you you have the potential for an engulfing C. Now, the engulfing C is really powerful because we're now going back into the trend. Now the 50s roll to the downside, the 15s roll to the downside, and what happens here is a huge number of sellers come back into the market, and what propels this trade down are 2 forces. One, the addition of sellers that come in with such enthusiasm and with such power, they engulf the buyers here. So not only does it get forced down by the addition of sellers, but everybody in this B candle gets stopped out. And a lot of our C candles just fire out. And when they're propelled down, oftentimes, and we can't prove it, but I believe it's because everybody in this B candle are trapped, they're stopped out as this candle closes and moves down, and we trap them. And they have to close their position, and to do that, they have to sell. And they push the candle down even further. Same setup. We will move to the downside. There's some set of buyers that decide the market's gone down enough. They're calling a bottom. We stand aside. We wait for the C to engulf them. We already have our sell stop or sell stop limit order waiting 1 tick below the close. We know where the close is going to be because we have a range maker. The candle's outlined in pink. That means order flow and momentum are with us on multiple time frames to the downside. And we got 2 forces propelling it down, the addition of new sellers, and we're squeezing all of these buyers in this candle. And you see they try to do it again. Here they do it successfully, but here the market is successfully oversold. And I'm going to show you how we define oversold. And this is an oversold definition that really actually does work. Again, same move. 2 candles in a row red defines a trend. B, try to stop the market, bring it to the upside in a clear-cut downtrend. C engulfs them, and down it flies. We have other signals. I'm really not going to go into them in much depth because I want to roll over to our charts. We have momentum signals when momentum aligns on multiple directions. Momentum is a great signal. When the MACD is moving in your direction, when the indicator line is accelerating away from the slow line on multiple directions, it's a powerful signal. And we're retracement traders. We always wait for retracement to a confirmed trend. We look for people to run over and move up in a failed attempt to turn the market. We almost always do that. This is a momentum entry to the downside. Same principle, though. Here's another momentum entry. This is a great structural setup. A break of the 15. It comes back and retests the 15. Up you go. The momentum signal tells you that you're aligned on multiple time frames, and momentum's in your favor, and up the market goes. You can see, though, our general basic thesis of always trend trading with the 15 and the 50 in our direction, always trying to trade in the direction of order flow and momentum, and always trying to trap people in a failed counter trend move, always remains intact. Here it is again. This is a power entry. We have the move down, retracement right back to the modified 15, down we go. Move down, these green candles in a downtrend, finally move back to resistance, and down we go. Again, same thing, strategy entry. Break, retracement to the 15, up we go with the trend. We leave these sellers, all stopped out. This is a strategy entry and a C candle entry. And you can see how it's getting redundant, which is actually in a way is good. This is a huge move, 37 ticks on a break of the 50 and the 15 with order flow and momentum. Now this is not a retracement trade. This is just a clean break of resistance to the downside with order flow and momentum, and down you go. Now, here's what defines, and then I'm going to go over to the charts. Here's what defines overbought, oversold. And I'm going to go back to here. If you look in the upper left-hand corner, you can see slope, volume, and then MA diff. When the distance between the 50 and the 15 is greater than 18 ticks, when the space widens to the point where it's 18 or more, that's where you start getting overbought or oversold. It's not based on the stochastic. It's based on the distance between these two. And we've proven it using a year of market replay data. When the MA diff starts to go to 20, 21, 22, that's where the market is oversold. So we watch the MA diff, and on the right edge, we have the safe zone. And the safe zone is always 18 ticks from the 50. You can only see it on the right edge of the chart, so you can't see it here. Now, that doesn't mean you can't take a trade with an MA diff at 20. You just have to realize that if you do, you've assumed a little bit more risk. If you want to stay ultra conservative, you're going to stay with that MA diff less than 18. If you want to take on a little more risk in a perfect structural setup with indicator confirmation, you can definitely do it. And now that we've perfected the art of the analysis of multiple asset classes, you're going to see how much power it adds to our charts. So that's what the MA diff is. This is just total volume of contracts traded. We don't really use the slope of the 50 much, and occasionally the slope of the 15. That's just really a nuance. I could show you that at some other time. Now, what we did in order to give the predictive power of the predictive value of the chart, even greater predictive power is to create background bias. Now, what I really, really like are indicators that are not influenced by price action or market structure of the chart we're trading. That's like the big canard and the really big thing that can fake you out. You look at a static chart and you look at a stochastic. Every time the market drops, the stochastic drops, because the stochastic and price action on the chart affect each other. And it looks at a static chart like stochastic or relative strength are just these superlative indicators. But then when you go to a live chart, and that right edge of the stochastic is bending up and down, and the candle is moving around and waving in the breeze, it doesn't have such great predictive value anymore. Well, the background bias is not affected by anything on the chart. What it does is it analyzes market structure and price action from 2 higher time frames. So you'll notice that the market is most likely to go up on green bias and most likely to fall on pink bias. But none of the price action on this chart affects this color. It's because this is analyzing the 50, the 15, price action, and market structure on 2 higher time frames. So if you really want to be conservative, you're going to short the market only on pink bias, because you know you have multi-time frame market structure price action, and you're only going to get pink when you've broken all resistance to the downside, or all support to the downside. You're only going to get green when you've broken all resistance to the upside. That creates a scenario where the likelihood of your entry signal is going to be much more likely to be a winner. And that's really why I like this background. It doesn't make any difference what price does. This is fixed by higher time frames. All right, now what I'm going to do is I'm going to drop the slides and I'm going to go over to the charts. Just hang on 1 second. I may have to reshoot the screen. Hold on 1 second. I have so many charts up, but I'm gonna move them around. Okay. Now what I'm gonna do is I wanted to start off just by showing you that money is really rotated among 4 different asset classes. There's currencies, there's currencies like the 6E. There's stocks like the ES. There's notes and bonds like ZB. And then there's commodities like corn, gold. There's precious metals because there's subdivisions of commodities. But money is really just rotated among these 4 asset classes. You know, if people have a period of indecision and they're worried about stocks and bonds, they're going to head towards bonds. They listen to the crop report, and if corn is going to be doing really well and going to go up, maybe they'll move their money from stocks into commodities like corn or gold or crude oil. But money is just constantly being rotated. I mean, it's never created or destroyed, and institutional money in the billions, maybe trillions of dollars, is simply moved among these asset classes. And what we want to do is use that information to give us even greater validity on our trading entries. And what I'm going to do is show you how we validated that on the ES chart. And I could do it on any one of them, and I'll do it on others too. Now let's take the ES. Let me just refresh it. Okay, now we have background bias. Now, what we're looking for, now remember, we trade with a tremendous amount of specificity. We're not going to get a setup that we like very often, but when we get a setup we do like, that's when we're very, very likely to get a winner. Now let's take a look. Now the problem is that all fractal indicators that do multi-time frame analysis are not handled that well by NinjaTrader. I could go into a whole in-depth thing about that, but I want to find you a really, really good signal and show you what I'm talking about, because the signals are not exactly the same. Okay, right here. Let's take a look at this signal to the upside. And what we always look for, just as I showed you on the slides, is we look for the break and we look for the retracement. We know that the 50 is green, the 15 is green. Now the 3-line indicator is gone, but you can see that the candle's outlined and tells you that order flow and momentum are aligned with you on multiple time frames. Now our background bias is green. That tells you that market structure and price action are with you on multiple time frames and that you have no resistance to the upside. The only question that you have on this trade is whether or not you're going to break this pivot. Now, just for the purposes of teaching here, we're going to say that we decide we're going to. You see that we also have the triple momentum signal. We have so much going for us on this trade, we believe it's going to be a pivot breaker. Then we look down here. Whoops. Sorry about that. And we look at our RL Quant Analysis Indicator. Now, these two lines, what they're doing is they're correlating the direction of 5 markets that have a correlation coefficient of 0.7 or greater. Now, some of these markets move with the ES, 70% or greater, or greater of the time. Some of these markets move in the opposite direction of the ES, 70% or greater of the time. But when both lines are green, it tells you that all 5 asset classes in which money is either rotated into along with the ES or out of and into the ES are moving in your direction. So the likelihood of getting a winner here is extremely high. And there you go. For 2.75 points, you just have to wait. Now the top line is the major quant line, we call it. And the bottom line is the minor. And I want you to see this trade. I did not tell you about this indicator. This is our consolidation indicator. Now when you get sideways movement and the consolidation indicator prints in real time, it's not a post-win print. When the 4th candle prints, you get, I put an audible beep because I love to trade out of consolidation, because the longer the period of consolidation, the better the chance you have of getting a nice move. Now, what's great about it is it moves the market right to support. And when you get to support, background bias is with you, the major quant line is with you, the minor one is just neutral. The assets in this class are not moving against you, but they're not moving with you. It's a little bit riskier, but this is really, really a nice setup. You're in, and this is another 3.5 points. Now, you cannot trade a yellow modified 15. That's our rule. So we just don't. And remember, I like to trade only with background bias. So there's none here, and I just leave all this alone. And you can see how choppy it is. When the higher time frames don't align in terms of price action and market structure, oftentimes the price action on your trading chart is a mess. And yeah, could you trade it? Yeah, but I wouldn't do it. Because what you want to do is you want to wait for your perfect trades. Now here come your potential trades. We don't get anything. Now, is this a potential trade? That's very tough to get. I want to make things up. We're going to get big moves. And I want to get you to another really, and here's our nice trade. And you can see they don't come often. Right here, your dual quants All 5 asset classes are green. You have a perfect trade in a period of consolidation right to support. The candles outlined in order, flow, and momentum. And you have the best green color. And up you go. Now, there's been a lot of potential trades, and they're riskier trades. Some of them were successful, some of them weren't. But we're all about waiting for the optimal trade and only trading with a tremendously high degree of specificity. We don't care about all this. And there was a couple of big moves, this big move to the downside. Unfortunately, there just was no way to get that trade. Now, it occurred at 15:59.27, which is, which I think is, which is about 4 o'clock in the afternoon. So obviously, we're not going to be trading that anyway. But let's just go back another couple of days. Let me just move to let me move to a different class. Let me move to what I'm going to take. I'm going to bring over crude oil. Now, crude oil has only one quant line because we can only find 3 asset classes that correlate with a coefficient of 0.7 or greater. And let's take a look at crude. You know what? I'm going to show you gold because I want to show you a trade today. I want to show you what happens if you have patience and you wait for everything to align. Right here. That was a trade I took in the live trading room. It went 26 ticks. And it just came within 1 tick of giving us a 48-tick trade. I'm going to take this all out. And this isn't a hypothetical trade. This is a trade I took. You know what, Trader Tom, I can't tell you that because it's taken us so much time to figure them out that if I told you that, I'd be giving away about 65 to 70% of all the work we did. It's very, very difficult. We had to run a year of market replay data on 50 or 60 markets to pull out the asset classes that have that 70% correlation coefficient. It's so difficult. I'll just tell you that in the mix is the US dollar, the Canadian dollar, the interest-bearing instruments. They all bear a very strong correlation with gold and crude. Yeah, so that it's really hard to do that. But here's the perfect trade. You get the move down, the retracement right into the 15. The 15 and 50 are red. You look down. The quant analysis is telling you that our 3 asset classes are moving exactly in the direction we want to pull gold down. Now we're out of gold on a reversal candle. It went 26 or 27, and then we were out on the close of this reversal. Now it just reversed. It only made one, if this would have been 1 tick less, it would have taken us all the way down to 48. That's how powerful it is. Now, if you look at gold the rest of the day, nothing. Absolutely nothing compelling to take a trade on this market. And and when you get this far into the end of the day, you're just not going to trade. And I'll show you on crude. Actually, what I'm going to do is I'm going to show you the Russell. I can't change the chart. I'm sorry, because the quant indicator is each market has its own quant indicator, so you just can't rotate them like that anymore. And we have a quant for each asset class. So let me find my Russell chart. It's right here. Now here's my Russell chart. And this is with the Russell quant. Now we do, like I said, volume's important. And let me just show you the right edge. On the right edge here, this orange number gives you the number of contracts crossing per minute. And that's a really important number. If this is like 50 or 60 on the Russell, don't trade it. I mean, you know, volume is what provides power to the engine to make these instruments follow through with their moves. The magenta line that we cannot, just because the way Ninja's configured, we can't move it aside, is simply the average number of contracts traded on a 15-bar look back. It's simply this magenta line. But the important number is that orange number. If you want to see the total number of contracts crossed, you can go to the upper left-hand corner. There's volume. There's the MA diff. There's a slope of the 50 and the 15. But let's take a look at the Russell. Let me go back a little bit. I can't find. I had some spectacularly huge trades on the Russell, but what we're going to do is we're just going to find them. And let's go to a market open right here at 950. And this was yesterday. I remember this yesterday. And these are the kind of, this is why there's that 15% of trading is discretionary. You get a nice move to the upside here. Then you get this retracement right here. And you can see clearly, your quant line is with you. Background bias is the second most powerful color, blue. And you've got yourself really, I consider this to be an easy win right here for 12 ticks, 2 targets. Then what you get is you get a second retracement. And here you have to ask yourself whether you believe that pivot's going to break. I didn't take this trade. I was concerned about the pivot. Some people did take it in the room. It just walked through the pivot. Right through. 15 ticks. Now, if you trade our ATM schedule, we trade 3 contracts, you're done for the day. You've made $500 on these 2 trades, and you're finished. And you can see that you've taken them both with the quant line, this one with order flow and momentum, always trend trading with background bias. And even though we can't get a trade off of this yellow modified 15, you can see when this background bias is green how strongly the tendency is for the market to rise, because those higher time frames are just going to pull price action on this shorter time frame up. So we are never going to take a short in this scenario. And sometimes you will occasionally see green bias on below the 50. Now this move occurred right here. Now we were done trading by then. I mean, we were finished in the room. But here is your perfect break of the 50. Remember all the slides I showed you? There's the trade in real time. The 15's up. The 50's up. The quant line is going to turn green. And up you go for 31. Now this is a tough retracement to take. It's way off the 15. And I wouldn't take that trade. Remember, we want to be 4 ticks or more, 4 ticks or less. But if you did take, and it's into a pivot as well, this is 13 ticks off the 15. It's way off support, and I wouldn't take it. But you've got yourself a beautiful 31-tick trade. Here's a trade into a pivot. It's really just a question of whether or not you believe the pivot's going to break. This is a breakable pivot. It's a very small pivot. And I really like it. It's consolidation right into support with order flow and momentum. Now in this trade, you don't have the quant line. And so this would make this an iffy trade. I want to trade with this quant line. So I wouldn't take this trade. That's just my specificity. And I'm going to let some winning trades go because I want to trade with it. And here's another great trade. And this is at 10 o'clock in the morning. You move down, up. Now, I believe we took this trade. I can't remember. and this is a great trade to the downside. You could have entered here. You could have entered here. Everything is working for you on both of those entries. And depending upon which entry you took, it's going to only make a difference of a tick, but you've got 20 ticks. The thing that's important to see, and I'm not going to go much further than this, is if you wait for your setups, if you wait for background bias, if you wait for order flow and momentum, if you wait for the quant line to verify the direction on our multiple correlative markets, and you wait for all of this to align, then you're trading with such tremendous positive predictive value that you're going to get very few losers. This is why this week I'm 11 wins and 1 loss. I simply wait for all of this to occur. And it's very tough to suck in a loser when you trade right off resistance here, again, order flow and momentum, and your correlative market, either your one quant on crude or your dual quants. Now the Russell should have 2 quants. Where'd they go? Whoops. Let me. I have the wrong quant there. I'm getting myself all balled up here. Here's your dual quant. Your dual quant. Now the ES has always been difficult for me to trade, but the quant lines have made it much easier for me to trade. Today in the trading room, I had a 27-tick trade on gold, and I had a 5-tick trade on the ES. That was the day. We made about $400 in the trading room today. We're up about $1,500 for the week, and that's it. Sure, I will show ZB. I love ZB. I've got to tell you, I may have to switch. Let me find it here. Here's ZC. Let me find ZB. I love, we created dual quants, and we just released them today for the EC for ZB and ZN. And those are really difficult markets to trade. And I'm telling you, the quant lines have just made it a whole different ballgame. Let me just find the chart. I'm sorry about that, but they're all over. Now here's the YM with dual quants. I don't want to waste any time on this. The YM is an excellent market. We also have NQ. The NQ quants are fabulous. The NQ is a really choppy market. If you wait for the dual quants to kick in, right here is your trade. You just, both quants are green, you've broken the 15 and the 50, you've got a dot. That allows you to take this trade to the upside. And there you go on the NQ. If you want to take a trade, again, without the quants, you want to take it without this dark green background, you know that your predictive value on the trade is markedly diminished. Now let me find ZB. I may have to switch. Oh, here it is, right here. Let me show you ZB. Now bonds are worth $32 a tick. That is a lot of money. And I'm going to show you how great our ZB quant lines are. We can start. Now, and I just want you to understand that one of the great things about these is they keep you out of bad trades. Like you're not going to short, you're not going to go long on a red quant line. I mean, they really tell you when the market's going to give you a loser. So they're really helpful. Now on ZB, there's no real dominant quant line. You can really trade a perfect setup with either quant line red. If they're both red, it's even better. But here is your first trade. There's your break to the downside, your retracement right back to resistance, order flow and momentum. This is a very powerful background color to the downside. There's your number 2 quant line, which is just as powerful as number 1. You definitely want one of these 2 red, and the other one can be yellow. And this is what we would teach you, but on this trade, if you're in 1 tick below, this would have taken you and given you 11 ticks at 32 bucks a tick. If you trade now on one contract, that you're not going to pick the bottom, but that's a very lucrative trade on 2 or 3 contracts, let me tell you. They really don't have another trade. Unfortunately, this breaks to the upside on a yellow 15 and a yellow 50 and a red quant. Can't take it long. But like I said, if you trade with specificity, trades are going to go by. There's the next trade. There's the break. There's the retracement. You're trading right off support. Now you have dual quant lines with you. You're in 1 tick above. And this is going to take you all the way up to here. 11 ticks. Now you're going to wait again for the best color. You could take this trade to be a winner. This trade, perfect. Dual quant lines. The retracement. These poor unfortunates in the B candle. Down and up you go. Not a big trade, but it's a winner. Actually, it's only 3 ticks. But then you have this trade on this retracement. And this is a huge trade. I mean, if you took these 3 trades today on bonds, you'd be done at $32 a tick. So the dual quants on bonds are terrific, and they're equally as good on notes. And they're great on the 6E. So this is all the predictive power that we can provide you with in terms of getting you a successful trade. Now, just to close, you see that 10 to 15% of trading is discretionary. You may decide that you don't want to trade into a pivot, and the trade just walks through it, and up it goes. But here's the thing about trading, and I really want you to understand this. If that happens, never get upset or never be concerned about it. You didn't think the trade was going to go. You don't have a crystal ball. One of the toughest places to be when you're trading is the right edge of a chart. When you've got your money on the line, if you don't want to trade into a pivot, no big deal if the trade goes. That's my attitude in the room. If I don't trade into a pivot and the trade goes 455 ticks, I know why I didn't take the trade. If I'm just, looking outside at the sun, then I should throw myself off the chair and roll around on the floor. But if methodologically I don't want to take the trade and I understand why, and the trade is successful, you should never care about it. And you must have tremendous patience and wait. The other thing is that trading shouldn't be fun. It's a boring endeavor. If you're in a trading room, it livens it up a little bit. But it's a very solitary job. And sometimes we have to wait an hour or an hour and a half looking at 4 different markets before we get an alignment that we're going to take. But you're not going to get 11 winners out of 12 trades if you just chase every little thing that happens. You've got to wait for everything to come into focus. You've got to wait for the green background, the pink background, order flow, momentum. You've got to wait for your quant lines, and the market is not going to give that to you very many times in the day. When it does, you've got to be ready to grab it and go with the trade and have faith that the trade's going to get to your first target. You cannot trade scared. And that's really it. I mean, the platform defines the predictive value of your entry. And that's what's important. You cannot trade a black box system, and you cannot trade a system where each indicator does not come the predictive value associated with it. I'm just going to show you our right edge. You can see here that 4. The 4 is the distance from resistance to the candle open. And I know if this was going to give me an entry, I am close enough to resistance to take the trade. I already know where my candle open is going to be, my candle close is going to be. And if you just hang with me for 2 seconds, I'm going to show you something real quick. We even have our own trading dome, which I'm going to put up really quickly. which comes with the platform. Now here's our bond. Here's the bond dome. Now let's say this is connected to your NinjaTrader Superdome. Now let's say that I want to take a trade on a close to the downside. And remember, when you're even on a range chart or a tick chart, you can trade any type of chart you like. You never know exactly where the trade's going to close. So all we do is we just press this button, buy on an up close. And as soon as the candle closes, the dome fires a signal to take the trade as fast as possible on the close of the candle. We sell on a down close. So we buy at an up close, we sell on a down close. And we trade off of this dome, which is connected to our NinjaTrader dome, which really facilitates our entries really, really significantly. We don't have to keep following that entry. It's especially powerful on tick and time, where you have to wait at 10, 9, 8, 7, 4, 2, 1, 0, and then rush in. This is going to fire in that trade on the close of the candle to the buy up to the upside or the downside. And let's say the market is heading down, and you want to close on a reversal candle. All you do is you put close on an up close. Now, I can't hit the button because we're not in a trade. But as soon as you get a reversal candle, this is our trailing stop. Down, down, down candle, down candle. The first close of an up candle, close on an up close, we're out. So this really, really facilitates our entries and is part of our platform. And if I show you here, I've only enabled ZB, but you're going to get a drop-down window, and you're going to have all the instruments you trade, and you're going to format as many of these as you want. I put them in the trading room in the lower left-hand corner of the chart, and I take all my trades right in front of the traders on this platform. And they can see if we have an entry. It candle stamps the charts. So that's just a little added thing. We spent a lot of time working on this, and it's patent pending, because there is no other dome like this that configures trades the way this does. And this it just follows those trades like a bloodhound and takes it on the close of the candle. So I don't want to hold up any more of your time. I just want to let you know that we do have a special, and we have two specials. And let me bring up the slides really quickly. Can they see the slides, Leo? Okay. I don't think I even have it on here right. I don't think I changed it. It is right. The entire software package, the NDT platform, which is this, 6 months in the live trading room for $29.99. Now normally I think it's what is it, $49.99, Leo? It's $49.99. So this is lifetime ownership of the software. The other special is, and it's on the website, if you buy 2 months, you get a third month free. A month is $3.99. And it gives you the software, it gives you the NDT, it'll give you the personal mentorship, but it only gives you 3 months in the trading room for the 3 months that you sign up for. So it's about $798, and you're in the room for 3 months instead of 2 months. Or you can just lease it without the special. You can lease at $3.99 for 1 month if you don't want to take care of the special. We also welcome you in the room on a free trial right here. You can go to rightlinetrading.com. Thank you, Leo. And you sign up for a free trial. Now, if you sign up for a free trial, we're not going to put you in the room tomorrow, because tomorrow's Friday, then we have Saturday, Sunday, Monday, the market's closed. What we'll do is we'll put you in the room next week, Tuesday, Wednesday, Thursday, and Friday. And we'll still make the special available to you at that time. We won't pull it away from you. If you're in the room and we've got your email address and you're in this webinar, we'll still make the special available to you. So that's really it for the webinar. I really, really thank you all for coming. I think we have a really, really terrific program, and I think our software is the best. I really might be prejudiced, but I trade it every day, and I really, really like it. Are there any questions about it? Okay. All right. Well, listen, I thank everybody for attending, And you know, I look forward to seeing you in the trading room. And I wish you nothing but a ton of success in your work.